Have you been watching the stock market lately? If you have, you've probably noticed something strange. Over the last few weeks, global markets have been on an absolute tear, climbing higher and higher, almost defying gravity. From Wall Street to Tokyo, and even in the Middle East, major indexes are flashing green. This has caught a lot of investors by surprise. Weren't we all bracing for more volatility and uncertainty? So, what's going on? Why are stocks rallying right now, and what does it mean for your money? The answer lies in one powerful force: the expectation of a Federal Reserve rate cut. Traders are now betting heavily that the Fed will start cutting interest rates as soon as December. And that single idea has sent a wave of optimism surging through the financial world. To really get what's happening, you have to understand a simple truth. Interest rates are like the global economy's gas pedal and brake. They control the flow of money. When the Fed raises rates, like they've been doing for the past year and a half, borrowing money becomes expensive. Think about it. Mortgages get pricier, car loans cost more. And for big corporations, funding new projects or expansions becomes a much bigger financial hurdle. This tight monetary policy is designed to slow down the economy and fight inflation, and it works. Companies pull back on spending, consumers tighten their belts, and investors, feeling a bit nervous, tend to move their cash out of riskier assets like stocks and into safer havens like high-yield savings accounts or government bonds. That's been the story for a while now, a tough, high-pressure environment for the stock market. But here's the exciting part. The entire narrative is starting to flip. The latest economic data is telling a new story. Inflation is finally cooling down. The job market, while still healthy, is showing signs of slowing its frantic pace. And most importantly, the economy seems to be achieving that perfect soft landing everyone was hoping for, stabilizing without crashing into a deep recession. This is the green light the market was waiting for. It signals to traders that the Fed's job is almost done. With inflation under control, there's no need to keep rates punishingly high. This is why the market is buzzing with talk of a rate cut in December. The moment this expectation gained serious traction, the markets didn't just react, they exploded. In South Korea, the Kospi Index jumped across the entire Asia-Pacific region. Major indexes followed suit. Even markets in the Gulf, which are heavily influenced by US monetary policy, strengthened on this wave of rate cut optimism. So, why does the mere hint of a rate cut send stock prices soaring? It's all about what lower interest rates do for business. First, it makes borrowing cheaper again. This is like a shot of adrenaline for the economy. Companies can more easily fund new factories, hire more people, and invest in research and development. This fuels growth, and investors love growth. Second, from a valuation perspective, lower rates make a company's future profits more valuable in today's dollars. This is a bit technical, but think of it this way. When you can get a good return from a safe investment, the potential reward from a risky stock needs to be much higher to be attractive. But when safe returns fall, stocks suddenly look a lot more appealing. This effect is especially powerful for growth-focused sectors like technology. These are the companies betting big on the future. Think artificial intelligence, electric vehicles, cloud computing, and renewable energy. For the past year, these stocks have been under pressure. But now, with the prospect of cheaper money on the horizon, investors are rotating back into these high-potential areas. They're shifting from playing defense to going on offense, chasing a piece of the next big thing. However, and this is a big however, it's not a free-for-all. This rally comes with a pretty significant catch. Not every stock is going to rise equally, and some parts of the market might be getting ahead of themselves. The excitement around AI, for example, has been so intense that some analysts are starting to whisper the word bubble. Valuations for certain tech giants have shot up to levels that might not be justified by their current earnings. This means that even with all this optimism, volatility is far from over. Being strategic and selective is more important than ever. You can't just throw a dart at a list of tech stocks and expect to win. So, as an investor, what should you be watching right now to navigate this complex environment? I've got 4 key things for you to keep on your radar. First, and most obviously, the Federal Reserve's meeting schedule. All eyes will be on their official announcements. If they explicitly confirm that a December rate cut is on the table, it could pour jet fuel on this rally. But if they signal any hesitation, the market could pull back just as quickly. Second, keep a close watch on inflation and employment data. These are the numbers the Fed uses to make its decisions. If inflation suddenly spikes again or the job market looks too hot, it could spook the Fed into holding rates higher for longer, and all that rate cut optimism would evaporate. Third, pay attention to corporate earnings results. At the end of the day, a company's stock price needs to be supported by its actual performance. Optimism is great, but companies have to deliver the profits to prove their high valuations are justified. If we start seeing disappointing earnings reports, especially from the big tech players, it could be a major reality check for the market. And fourth, watch for sector rotation. This is about following the money. We're already seeing a shift from defensive sectors like utilities and consumer staples into growth sectors like tech and consumer discretionary. Tracking where the big institutional money is flowing can give you a clue about where the market momentum is headed next. This moment we're in is a fascinating mix of opportunity and risk. For some, it's a golden chance to get into strong, innovative companies while the momentum is building. For others, a more cautious approach is probably wise, especially when looking at stocks that already seem overvalued. But one thing is absolutely clear. The expectation of lower interest rates is the engine driving this entire rally. The big question on everyone's mind is, are we at the start of a brand new bull market, or is this just a temporary bounce before another downturn? The truth is, no one knows for sure. The answer will unfold over the coming weeks and months. But this is not the time to be asleep at the wheel. It's the time to be informed, to be strategic, and to pay very close attention. The decisions made by the Federal Reserve and the market's reaction will shape the financial landscape for the foreseeable future. Thanks so much for watching. If you found this breakdown helpful, make sure to hit that like button and subscribe for more insights into the markets. I'd love to hear your thoughts in the comments below. Do you think this rally has legs? Let me know. See you in the next video.